Kevin, let me start with you, Jeff. You point out and echo some of the discussions we've had even earlier today, that things like stock splits don't change anything, but they get the momentum going. The stocks go to levels that are obviously sort of unwarranted given current fundamentals. I guess you can never really say unwarranted. Someone thought it was warranted, but a sharp pullback is probably not to be unexpected and may not be the end of things. Yeah?
Yeah, I think that's probably right. And if you look at the 50-day moving average, for example, these things aren't trading on fundamentals right now. So technically it's important. So whether you're looking at the triple Qs or some of the individual stocks, most of them are right at that short-term technical support. So I think the next few days are going to be very interesting in terms of where that trade goes. But you're right. I mean, there's this weird prisoner's dilemma sort of thought process going on that's driving the share prices in a lot of these names. And look no further than Apple and Tesla and their stock splits. Investors know that stock splits don't drive share price value, but at the same time, those investors think that other investors might think they do. So everybody piles into those names and it drives the prices to levels that really don't make sense. I mean, Tesla was down 21% yesterday and it's still 80% above its 200-day moving average. So think about that for a second in terms of the magnitude of where we could correct. And you can pull back the lens a little bit too and look at growth versus value. The growth to value price ratio in the S&P up over 35% year over year. We've never seen that before. And then within tech, obviously a big component of growth, you've seen breadth start to contract a little bit. We were at 85, 90% of stocks trading above their 50-day moving average earlier in the summer. That's down to 55% now. So you're losing a little bit of momentum there, but at the same time, still not oversold. The XLK, the triple Qs, whatever you like, still 15% above their 200-day moving average. So definitely room to the downside. But like I said, I think the next couple of days are going to be very interesting in terms of the technical support that the market sees.
It's a good way of putting it, that Tesla was down 26%, but 80% above where its average was for 200 days. That just shows that sums up the move up and the move down. And Jeff, it sounds like you think it's not over yet. I want to get to Kevin now. So Kevin, when we talk fundamentals, and it's tough. That's why technicians are necessary, to factor in what the technicals say, because fundamentals may not come true, like for an Amazon, for 2 or 3 years. So it looked like it was out on, way over its skis, but eventually fundamentals might catch up. So it's hard to look at current fundamentals and say whether it's warranted or not. Sometimes you just need to go with the flow. But what do you think? Are we ahead of our skis on all these stocks?
I definitely think that we got ahead of our skis. The market went up too fast and too soon and too quickly. And so what you have seen happen is that you've gotten a bit of a pullback here. And from the March 23rd low to September 2nd highs, technology was up over 80%. So having a correction of over 10% is to be expected in such a short period of time. And so we believe that you should stick with technology because these companies represent about 28% of the S&P 500. They are growing earnings. We think that they're going to continue to grow earnings. So it's not time to get off or dump technology. It's a time to trim your position back because they have become huge overweights in a lot of portfolios. So you may need to trim it back and take some profits.
Since you do cover fixed income so much, Kevin, I mean, I might just drop that title given the action and, there's just nothing happening. But what should investors do to try to insulate the portfolio against too much equity risk? Where can you go right now? What are you telling clients for an asset mix for fixed income?
Well, what we've done is we've basically created a barbell, and we put corporate bonds and bought corporate bonds on the front end of the curve and long treasuries at the back end of the curve. And that's to be a shock absorber in the portfolio when we do get these pullbacks in the market in these risk off moments. But overall, fixed income has been unexciting. Like you said, we expect yields are going to be lower for longer. And so that is actually good for equity markets. It's just that, equity markets kind of overreacted, and they just need to reset for a moment.